Hello viewers, I am Akilandeshwaran Iyer and I head fund administration at DSP Mutual Fund. As you are aware, the finance bill has been passed by both the houses of the parliament with quite a few amendments. Amongst these changes, a very important change is done for certain categories of debt fund which have equity exposure of not more than 35%, also referred as specified mutual fund. Essentially, any gains or losses from unit of such specified mutual fund purchased on or after 1st of April 2023 would be deemed to be a short-term capital gain or loss irrespective of their period of holding. That is, the definition of holding for more than 36 months to be considered as long-term capital asset is withdrawn. It is very important to note that all investments up to 31st of March 2023 are not impacted and would continue to enjoy long-term capital gain with indexation benefits if held for more than 36 months. In effect, the following types of schemes are impacted. Debt schemes, which have an exposure of not more than 35% in domestic equities, fund of fund schemes, including international funds, commodity ETF like gold and silver, to name a few. Let me give you a brief overview of taxation of mutual funds prior to this amendment, which can be broadly classified under two categories: equity-oriented schemes and other schemes, which essentially included debt schemes, fund of fund schemes, commodity ETF, as I mentioned earlier. An equity-oriented scheme means any scheme which invests a minimum of 65% in equity shares of domestic companies which are listed on a recognized stock exchange. Capital gains on such schemes are taxed at the rate of 10% plus surcharge and cess for long-term capital gains and 15% plus surcharge and cess for short-term capital gains. All other schemes are taxed at 20% plus surcharge and cess for long-term capital gains with indexation benefits and maximum marginal rate of up to 30% plus surcharge and cess for short-term capital gains. What the new amendment has done is doing away with this long-term capital asset definition for such non-equity oriented schemes which has an exposure of not more than 35% in domestic equities. With this, there are essentially three categories of schemes from a taxation perspective from 1st of April 2023. Equity-oriented schemes with a minimum of 65% in equity shares, debt-oriented schemes which can be further classified into, firstly, a scheme in which more than 35% but less than 65% exposure is in equity shares, and secondly, a scheme having not more than 35% exposure in equity shares. Now let's consider the impact on set-off of losses. As per the current provisions, if debt funds were held for more than 36 months, long-term capital loss from such assets could be set off only against long-term capital gains, as losses from units of such specified mutual funds bought on or after April 1st, 2023 would now deem to be short-term capital loss. The same can be set off against short-term as well as long-term capital gains. Hope you find this information useful. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.